Hello, everyone. Welcome to another episode of the Alt Investor Podcast. My name is Yashunta, and I'll be your host today. And today, I'm delighted to welcome Manisheel Gautam, who is the co-founder of Investorey, a real estate and other alternatives aggregation platform. Manisheel graduated out of IIM Ahmedabad and IIT Bombay, very prestigious universities, and then worked at Ola for 6 to 7 years before starting Investory. In this episode, we'll learn specifically about fractional real estate, types of fractional real estate available, and what regulations cover them so that you can make the right investment decision for yourself. Welcome, Manishil, and thanks for agreeing to do this. How are you doing today?
Uh, Happy to be here. This is this is what we want to do: make more people aware about this investment opportunities, and the more information people have about it, the better they will make a choice there. So happy to be
Mhm.
here.
I'm sure you're happy to be here because you're leaving the India, match and all that sort of stuff. So,
Part and parcel of being a founder, right?
yeah,
Things
exactly.
exist in society. Yeah.
Yeah. So, Manishi, let's get into it. Can you, for the audience, can you tell us, okay, what's your journey up till like Investory and what are you trying to solve with Investory as a platform?
So I'll start with this. Start from the start. So I've been
Yeah.
part of the startup ecosystem for the last 6 7 years, just out of engineering, into thrown into the startup fire, which was Ola at that point of time. I joined Ola at decently early stage. This is
Mhm.
2014. Saw the journey go up from like 5,000 rides a day to 5 million rides a day. So seeing multiple businesses being set up within a business, got the experience of managing a category, managing marketing. I thought it was a good time for me to get out and start something of my own because I had the right tools to do it. Uh,
Mhm.
we at Ola shared an office with Strata, so we knew
Mhm.
at least about the asset class. We had FaceTime with the founders there, so we were generally peaked where we had interest in what the category was. So when I
Mhm.
quit, I asked Shikaru, is my co-founder, that do you want to explore this category? Real estate is a decently big investment opportunity across the country. Sorry.
Mhm.
Almost every household has thought of investing in real estate in
Mhm.
big enough problem, and it was fairly unorganized. So we thought good place to be. We have seen Ola journey go from so very small to very big because it was an unorganized market. We thought we can do the same here, and that is the whole aggregation play came into the picture. That
Mhm.
is when we went across and started Investory in 2021 end. So this is where we
Mhm.
started. Now we are here where we are trying to help Indians make better choices while investing in real estate.
Mhm. We know so many different kind of alternative assets now. I mean, why particularly real estate? What made you think of real estate? I know you talked about sharing office with Strata and all that sort
Uh,
of stuff, but
Apart from that, and I'll answer that from a very fundamental point of view, which is happening in the last 2 years. Post pandemic,
Hmm.
you have a lot of financial, I would say, bad issues across the globe, with
Hmm.
debt piling up, economies not doing well, civil wars being fought. It has and it will continue to affect financial instruments across the whole globe. Now, at the end of the day, physical assets, and that is the reason you have seen such a spike in gold as well. Physical
Hmm.
assets, which will not be directly influenced by these market parameters or things happening across the globe, are real estate and physical assets. So we were
Hmm.
very gung ho that as things get worse, and they have gotten worse, at least from a globalization point of view, people will start moving towards real estate as an asset category where they want to park in some amount of money because that's
Hmm.
fairly secure in a country which is growing, even though the world is going to the dogs. If I want
Yeah.
to generalize, if I want to generalize it, but real estate is a category which will stay. So we, and plus everyone knew about the asset category in general. Everyone knew about real
Mhm.
estate. So we thought we want real estate to be a big part of what we do going forward.
So thanks, Manishil. So let's say, a lot of platforms are coming up right now which give you fractional ownership or, give you fractional investment options. Can you explain to the public what does a fractional investment mean? And, what are the options available in the market right now?
Okay. So before we get into the second part of the question, let's
Yeah.
actually understand what does fractional mean. Why does why do people do fractional, and then who is doing what? So at the very essence of fractional ownership is crowdsourcing of funds. You are basically taking a bigger asset or a bigger investment product, reducing it down in terms of ticket size, and then letting more people get access to it because someone might not have 100 crores to spend, but people might have 10 lakhs to invest in a place where they can get good returns. So it's a good place for people to get entry to into the real estate investment asset class, where they don't need to park a lot of money and they can diversify. Now, getting into how does fractional work, we
Mm-hmm.
need to segregate it into two parts. So one is a traditional way of fractional, which has always existed, but happens at an offline level.
Okay.
There is no one bringing them together. Then the fractional investment on the new wave side. Now, I'll list down the traditional ones because they're fairly easy to understand. So when you go into fractional investment on traditional mediums, you either have direct registration based investment. If there is an office, they will
Mm-hmm.
divide the office into, let's say, 10 parts, and everyone gets physically verified. Okay, I will get 500 square feet out of it, and then the registration will be done in your name. This was cumbersome. That is why the new age investment came into the picture. Then you have things like NCDs, or
Mm-hmm.
non-convertible debentures, where builders raise money for financing. And then you have lease rental discounting, where your if there is a commercial place where there is a rent being generated, they can use that rent as a leverage to raise money at a certain price.
Got it.
And then there was always fractional agri land, where people would take smaller part of a plot, bigger plot, and get investments or get returns on their agri investment. So these are other traditional sites, have been there across the whole Indian ecosystem, but not organized again. The other side, which is the new age investment, is the one where people are getting interested about, where you can, for example, own a part of an office or a warehouse or a manufacturing plant at, let's say, 10 lakhs. Or we've just onboarded a new partner called Clara West, which is letting you own residential real estate, under construction residential real estate, for 1 lakh. So you can get money out of it. Then you have holiday homes as a new category, which is coming up significantly, where you can own your second house, let's say in Goa, at 15-20 lakhs. Whereas if you wanted a good place to stay in Goa and you wanted to buy it, would be upwards of 2 crores. So brings down the cost, it makes it more accessible to people. And then agri land also, people are getting into the model where it gets to SPV based model, or SPV based ownership. All the new age model are done through the SPV based model. SPV is the full form of SPV is a special purpose vehicle. The whole purpose of that company, it's a proper company. Whole purpose of
Okay.
that company is to own the asset or the real estate. That company cannot do anything else. So indirectly, you are owning a share of the company, and that company owns a part of the and that company owns the full asset. So you got indirect ownership out of it. So
Hmm.
that is why that is where the fraction ownership SPV based comes into the picture.
So these SPV transactions or these SPV vehicles, do the investors need to do any sort of compliance on them, or how does it work?
So investors don't need to do any compliance on them, but we will always recommend do your check on what the compliance they need to do and they are doing it or not.
Hmm.
Most of it is based on the AMCs. AMCs have some guardrails which they need to cater to, either filing of investments on ROC or MCA portal, or giving out rental returns as per timelines what they have committed. Now, this
Hmm.
whole piece on the SPV based or fractional ownership based on company is not regulated completely.
Okay.
The real estate aspect of all of this is regulated through RERA, and
Hmm.
the ownership of the company is regulated through ROC and MCA. Now, the
Hmm.
draft regulations are in place, which have come in May 2023, uh, fairly encouraging, where most of the questions were answered on the how the asset classes will evolve. But till full regulations are in, they'll still be in the gray area. And we just want
Okay.
to call that out. Like, even though we know after the draft regulation, most of it seems legit and legal, and regulations will take care of things, but till it is done, uh, we would still want to call it out to everyone that it's in gray area. Does not seem like it will become illegal. It is actually becoming regulated. But for people who want to be secure, the most secure, and only want to invest in regulated instruments, then there is some time for them to get into this category.
Got it. So, I mean, talking about this asset class as a whole, if an investor invests in fractional opportunities, what does he or she get? And, what are the risks that they should be aware of?
Got it. So I'll answer the first bit, what you can get out of real estate.
Yep.
You will get the three things you get out of real estate.
Hmm.
which is your rental returns if it is a leased property, or I would say liquid returns if it is something like NCDs also give you liquid returns. It will be paid out as interest. The second thing you get in as a real estate asset class is capital appreciation. I'm investing in a place. India is a growing country. Demand for real estate is increasing. You are seeing a immediate uptick on the value of your real estate. And the third thing, which is now coming up as an aspirational category, is the experience side of it, where
Okay.
something like a fractional holiday home will give you more experience than a return, or owning a
Hmm.
coffee plantation in Chikmagalur will give you more experience than a return. It will be more value appreciation over time, or experience coming from the category. So you have these three things differing across different categories, where holiday homes and estates will be more experience, commercial real estate will be more rental plus appreciation, while builder financing will be just rental returns or liquid.
Hmm. Got it. And the risks that one should
And
be aware.
as you get the returns out of it, you should also see your risk accordingly. So we break down the risk into two parts, which is again to your liquid or rental slash interest income risk, and your capital appreciation risk or your capital getting lost. Now, the first risk which people face is why if you are investing in an income generating property, could be residential, could be holiday home, could be commercial, it's based on a tenant. So
Hmm.
you as an investor should always do your research on who the tenant is, what are the guardrails being provided by the asset management platform in terms of lock-in, lease agreements, renewal contracts, history of the renewal. If there is a tenant, what is that tenant? Is it a startup? Is it a MNC? What has been their financial history? Are they growing? Is the industry which they are in growing? So there are final elements which people can ask questions on who the tenant is, which will sort of give you some confidence that you will keep getting your rental returns or not. Now, getting onto the liquid side, the other builder financing, it's a builder financing product. Should always be aware if it is a grade B builder uh, or a grade C builder, you should always expect delays. We see it across the ecosystem. We will not mince words there. Grade A builders do their work. Grade B builders and grade C do it, but they tend to delay most of their projects.
Hmm.
We will not get into details why. So your NCD or interest payout might get delayed, or your capital might get delayed because you can't take it out. The third risk is in terms of well, not third risk. The capital appreciation risk is mostly either you're investing in a place which is not growing. You
Hmm.
know, like if you invest in a locality in Bombay which has maxed out, your capital appreciation is not going to be there. So
Hmm.
you're basically keeping your investment stable. The second thing which we see as a risk is mostly under construction properties. If it is under construction property, could be fractional builder financing or fractional commercial real estate. Uh, Again, the same builder is comes in. If the builder goes away or the developer falls into a legal hurdle, your capital is basically stuck. And I will give you just case in point example of M3M builders in Noida. Big enough builders. They were doing premium luxury rental residential. Now the promoters are in jail. The whole project. Uh, what time it will take to get it resolved? Will they get their money back? Will the building be complete? These are all questions which are in the air. So just coming from,
Hmm.
so basically dividing and summarizing what I've said is, on the rental side, do your research on the rental. If the renter is bad, you will lose your return. If your developer is bad, you will lose your interest payout and capital. So these are the key risks you see.
It sounds complicated. If a retail investor has to do this research themselves, it's very complicated. They might not have the right knowledge or not the right means to conduct this level of research, and which is where I think so Investory comes in and solves that kind of area, right? As a from a due diligence point of view, you will do all that due diligence and then only recommend that product to an investor. That's
We
the overall model, right?
Yeah. So we do
Hmm.
that. So basically, before any partner comes on the platform, we do their background check. What is the age? What is the founder feedback? What is the team feedback? Are they doing their compliances? Are they filing their financials? What is their financial history? What is their asset under management? Once a partner is given a green signal, then only they come on as a partner. Then once an opportunity comes in, then we do our due diligence again on what is the entry price. Does it seem right? Do they have all the documentation which is required for them to operate in this space? Does the project have all the clearances which they claim? So we on our end, because we have a structure in place and a template in place, we do it for our all our opportunities, and then we transparently put that across to any potential investor. This is it. You tell us after this you want to come in or not. Otherwise, we have, this is what you will get. This is what you should need while you're investing in real estate. That is very calm.
Maybe it's a weird question, but if these are partners, they have a bigger AUM, like let's say maybe company A has been doing a 500 CR total AUM across projects. Why can't they launch their own real estate investment trust, like a REIT, and then pool money in the listed markets? I mean, if you're aware of that.
People are doing that. At the end of the
Okay.
day, all the AMC platforms which are doing fractional real estate will bring in AIFs, and similar to REIT again. And I'll get into where I'm like, what's the key difference between the three items. And those AIF over time will keep picking up all these opportunities. At the end of the day, real estate is limited. They can
Hmm.
either go through the retail route, or they can take the HNI route, or they can get retail in through one place, and then 4 years down the line they can give them an exit through the AIF. That is what we
Hmm.
see is happening across, where if retail investors want, they can get an exit. Now, getting into the REIT point of view, why REIT and why FRE or fractional real estate? Think of it like equity and mutual funds. REIT at the end of the day is like a fund. You are giving your money to a fund manager who is deploying money across commercial real estate and under construction properties under some guardrails which are already defined, and giving you a dividend income, and your asset value will increase, or your REIT unit value will increase as the fund performances. What FRE does, or fractional real estate does, is you can now individually pick up the stocks or pick up the real
Hmm.
estate that you want to invest in. If I know there is a 10% rental income property which has good appreciation potential, I would want to park my money here rather than put 15,000 or 10,000 in a AIF is for very high value customers where your ticket size is that 1 crore. So not relevant to
Yeah.
majority of the people. So it
Hmm.
is just on the other extreme of the spectrum where, let's say you have REIT at 10,000, you have fractional real estate at 10 lakh, and you have AIF at 1 crore.
Hmm. And what's the general time horizon in these kind of fractional projects?
Generally, 3 to 5 years we see for commercial real estate.
Right.
For builder financing products, you will normally see a 3 year product. Holiday homes and experiential are more like perpetuity, that you can hold it as long as you want. Uh, Generally, you will only get your value on exit. If you're taking it for experience, then the number of people who are looking to exit are smaller.
Hmm. So for commercial real estate, you said 3 to 5 years. What happens after 5 years? What happens to my stake in the company that is holding that commercial property?
Okay. So at the first level, because it's a stake and not direct registration based ownership, if
Right.
you want to exit, you can exit before 3 years also, before 2 years
Okay.
also. We have enabled a couple of exits for our investors across our partners. So it happens. When I say 3 to 5 years, where these guys or AMC platform themselves project that we are entering into this property at this time, at this stage, we will look to exit it at 4 year or 5 year period where we see the maximum value. Where they will
Hmm.
then look for a new buyer or sell it to one of the AIFs.
Got it.
So that's where the retail exit will come into the picture.
And if they're not able to sell it, let's say, does the project gets delayed? Like, will my money be able to still come back after 5 years?
If only if either you get an individual exit or the whole property is exited, then only you will get your capital back. Otherwise, you
Correct.
will keep owning the asset. Worst case is you will keep owning a commercial entity which is generating rent, for example. That's the
Hmm.
worst case which will happen. With that's the best case with real estate, that your capital is more or less secure because the building is not going away anyway. Companies.
Hmm. And in these SPV-based models, let's say, if a dispute between partners happen or with the asset management company happens, is there any kind of framework that governs, okay, how will the dispute be resolved?
So then generally there are arbitration rules which are built onto the contracts. If you see
Okay.
the investor agreements, you will have that if there is a problem, this is where you will go for arbitration. If you can't get it resolved through an arbitration, then it will go to a court. Normally, because you as an investor, your rights are pretty limited. So you don't generally have any say in the day-to-day functioning of an asset. That is where the asset manager comes.
Hmm.
So you generally don't have issues between investors, because if someone is looking to exit and no one can stop him or her. If
Hmm.
75% of the people are looking to exit, then the AMC is forced to sell. So there is
Okay.
majority democracy built in for full exit. There is full full autonomy built in for individual exit. If there is a problem between the tenant or the building owner and the AMC, then that it's AMC's prerogative
We'll see.
to sort it out, and then it is on contracts between them. This is where having a good AMC partner is important. If you know someone will fight it and solve it for you, uh, that's the person to be with.
And in your experience so far in the last 2 years, have you seen any kind of project stalling or defaulting in terms of the tenants who have run away or the building did not finish, anything like that?
So we've seen 3 or 4 instances of things going south but getting
Hmm.
resolved at the right time. I will not obviously name partners,
Yeah, yeah, of course.
but there have been cases where construction building was started under fractional CRE, and the tenant, like at the end moment, even after signing the agreement to lease, did not go through with it. Now,
Right.
because that agency was good, they figured out a new tenant with a better lease and got them in. So it was resolved, but could have gone south. There are a couple of places more where there are some disputes happening between the partner and the developer, which again is getting going through the legal route. If we see any defaults or if something goes wrong, we will report it to public. We are very transparent about it. If someone is if there is a problem with one of our partners, we will call that out. Again, because these are not partner-led problems. These are like more individual property or builder-led problems. In most of that is where I was saying under construction is the most riskiest or the riskiest. Otherwise, fairly stable asset class to be in.
But having the right partner also, weeds out most of the problems, I guess.
Most of the problem. I think because at the end of the day, real estate people have power. Developers have a lot of say. Uh, you as an individual investor will not be able to fight. Well, you can, but it'll be a huge pain
Not
for
with
you
the
to
right
fight
means.
after
Yeah.
them. Whereas the AMC is not just going to deal with you; it has a lot more things and a lot more things at stake. They will have 1,000 crore AUM and their reputation at stake to solve this out. So it's important for them to have a good experience. So if someone has a vested interest that the experience has to be good and the investors are not conned, then you are in good hands.
Mhm. Okay, thanks, Manishil. Very insightful as usual. I guess, one thing uh, to take away from here is, you need to do a lot of due diligence on the partners as well and on specific projects as well sometimes. So, investors can definitely reach out to Investorey to do that kind of due diligence and choose the right partner. So, kudos to you guys as well. Now, to end right now, let's say in terms of, this is kind of a fun question just for the investors. Do you have any sort of fractional ownership or fractional investments yourself in your family portfolio? And do you do any kind of other alternative investments as well?
So to start with, founders rarely have a lot of money, but but in general, me, my family, and my wife's family, we have exposure to the fractional portfolio. I have personally invested in P2P lending
Hmm.
and some amount in agri investment with Property.
Hmm.
My family is invested in a couple of commercial real estate properties, fractional commercial real estate properties across Bangalore and one more place. So we have exposure
Hmm.
into the asset class. My family is fairly happy with the rentals they are getting. They're like, oh, we should not put up residential houses and then put it on rent and then manage
Hmm.
so much to get the same amount. I can just deploy it here. Then do not worry about it. Keep getting my rentals in place. So
Makes sense.
that family is fairly happy. Now I'm looking to diversify into invoice discounting and securitized debt as well. Where
Hmm.
we're partnering with Grip. I generally like their products, very safe, very stable. Invoice discounting, there are a lot of platforms, but again, not a completely regulated
Yeah, it's
category.
not
So
a regulated, but I think so. Grip has got Invoice X, which I mean,
it's a
yeah,
securitized invoice
yeah,
discounting.
securitized debt instruments. So,
So again, the
um,
way I have my investments across regulated to unregulated categories. Would not not my personal recommendation to invest anywhere. Would
yeah, of
ask
course.
make your ask the right question. We will give you the right answer, but people have to decide. No one should
Mm-hmm.
force anyone to invest anywhere.
Mm-hmm. Great. Thank you so much, Manishil, for sharing your thoughts on FRE. I'm sure this was helpful for a lot of people who are watching this. And if you have any questions for Manishil, he is a member of our WhatsApp community. And if you're not part of the community, do join in. I'll share the link in the description below. You can ask your questions there directly or just comment them below this video so we can get them to Manishil and get them answered. Uh, Thank you.
So
Oh.
thanks, Yash, for giving me this opportunity. I personally believe that it'll be top down in terms of awareness. There will have to be some experts who are solving the whole situation because it's not an easy place to be. And our discussion only points to that direction that a retail customer will go crazy if they want to explore this asset class across 25 to 30 different platform, understanding so
Yeah,
many places. So people like
definitely.
us, people like us, people like you, it's we will have to lead the way where we make it simple and accessible to access that information and how to go
Hmm.
about investing in this category, where you should and where you should not. I'm happy to be here to add to that information and knowledge in the ecosystem.
No, thank you, Manishil. Appreciate your thoughts. And thanks again. If you like this video, please do like, share, and subscribe so that this channel grows and reaches the right people. Thanks again.